Good afternoon, everyone. Thank you so much for joining us today. Today's 2018 GASB update will be a great presentation for you. I have just a few announcements before we get started. We do have a handout that's available for you to download in the Handouts pod. You can just click on the file and then download it to your computer. Audio will stream through the phone and through the computer, so you can choose how you would like to listen. If you have any questions throughout the webinar, you can type them into the questions box and the instructors will get to them as time permits. To earn CPE today, we do have 4 polling questions. Those will pop up on your screen, so when you see them, make sure you respond to them and you will receive a certificate via email in about 2 to 3 weeks. That's all for me, and I will turn it over to Melissa and Brian.
Thank you so much, Morgan, and welcome everyone to our annual GASB update. This is something, sort of a tradition, I guess, now that every year we try to give you an update right around this time on what's going on at the GASB. This year there is no shortage of things that are going on and that we need to be paying attention to. So we're going to fill this hour with a lot of really fun material. So let's start off with some introductions in case you are not familiar or haven't met me before. My name is Melissa Galasso, and I'm a director in the Audit Professional Practices Group at Bekaert, and I am out of the Charlotte office. But with me today, I have Brian. Brian, why don't you introduce yourself to everyone?
Yeah, I'm Brian Liffick. I'm in the Orlando office. I'm a manager here and work primarily in the governmental sector. So excited.
Well, we are excited.
Yeah.
All right, well, we're excited to have you today. So let's dive on in and let's talk a little bit about what's going on from a course perspective. It feels like there's just so much to talk about. So what are some of the high-level things that we're going to cover?
Yeah, so we have 8 different statements that we're going to try to cover today, as well as we're going to briefly touch on the implementation guides, exposure drafts, and upcoming projects. Those 8 statements that we're going to look at would be OPEB, which I'm hoping that everybody's pretty familiar with and gotten a grip on. And then we have irrevocable split interest agreements, which is GASB 81, which we'll touch on. Asset retirement obligations, GASB 83. And then 84 is fiduciary activities, kind of defining those and getting a little bit more clarification around those. Omnibus, which is GASB 85, has a little bit more detail of kind of a hodgepodge of items that there's further clarification on. And then finally we have debt extinguishment costs, leases, and disclosures related to debt, which is 86 through 88. So a lot of fun topics that we're going to dive into today and hopefully get everybody up to speed on.
All right, excellent. Well, as you said, we did do some OPEB work already, so hopefully that won't be too exciting. But before we dive into materials, let's start off with a polling question just to get a feel for who is on the line with us. So again, what we would love for you to answer is the question of, is what type of entity do you represent? So is it a public school or university? Is it a city, county, or town? State agency, other governmental entity, or you just not from a governmental entity. So kind of just trying to get a feel for who we have on the line here. So you do want to make sure that you are going through and completing this if you are looking for CPE. All right, so what type of entity do you represent? Now, this might not look as familiar from some of you. We did switch over some our platforms. We changed our learning management offerings here. And so that might look a little different to you, but this is definitely just getting your polling question here as to what type of entity you represent. I'll give you about 2 more seconds before we wrap up this poll. All right, it looks like you guys are doing pretty well here, so why don't we end this poll and broadcast those results? We have a pretty diverse group here, so 46% coming from a local entity, city, county, town. We've got 29% coming from either a public school or university, and then a little bit of everything at the bottom, state agencies, other, and about 9% of you are not from a governmental entity. So welcome to everybody. We're excited to have you here with us today. All right, so let's head back to those slides and let's keep on going. So as we said, we're going to go through. These are going to be at a pretty high level. We've already done an OPEB webinar where we kind of delved in pretty deep into the standard. So this is just going to be a refresher for you guys as we are thinking about implementing this right now. So let's start off here with a little bit of background. Can you just give us an update, Brian, on the timing of this and what does it address?
Yeah, absolutely. Thanks, Melissa. So GASB 75 was issued in June 2015, and it's going to be effective for our fiscal years beginning after June 15th, 2017. And primarily the focus was it was going to address the employer reporting related to OPEB, and it's going to address both OPEB plans that have assets in trust as well as those that don't. Now, the objective was kind of to improve the accounting and financial reporting of these OPEBs, as well as providing additional financial information and support in the financial statements for those readers. They do that through recognizing and measuring liabilities as well as those deferred inflows and outflows of resources, and then we're also going to see the OPEB expenses as well.
And so again, the most important thing with 75 to remember is that when 74 adopted the plan calculations if you had a trust fund, now that we're in 75, we're going to deal with the employer. And unlike 67 and 68 that only dealt with those that were in a trust, 74 and 75 addressed those plans that were in a trust and those that were not. And so there is no delayed effective date if you do not have a plan or a trust. If you have an OPEB plan and you don't have a trust, you still have to adopt it at the same time as those that do have a trust. So a little bit different in terms of the information there. So we do want to make sure that in terms of the application that people don't get confused and think they have a little bit of extra time. All right, so one of the most important things, as you mentioned, is that we're going to bring the net OPEB liability on our books. Instead of looking at a funding concept, which we've done historically, we're switching to full accrual accounting in terms of our reporting based on financial reporting, not based on the actuarial sciences. And so how do we calculate the net OPEB liability?
Yeah, so first we're going to start with the total OPEB liability that we'll kind of touch a little bit more on here in a second, which is going to be actuarially determined. And then the plan fiduciary net position is going to be subtracted from that total OPEB liability, and that's how we're going to get to our net OPEB liability, which is then going to be recorded on the employer books.
Now, for a lot of you, if you don't have a trust fund, you don't have a fiduciary net position, you're just going to recognize the total OPEB liability because total minus zero equals total. So again, when we're looking at this, you're going to be putting some liability on your books. If you have no fiduciary net position, you're just going to stick to the total. And we're going to walk you through how we calculate that total. So I call it PDA, project, discount, and attribute. And these are the three key steps that we need to do in order to calculate the OPEB liability. So Brian, why don't you just give us a little bit of a walkthrough on some of the key items?
Yeah, so the statement went through and identified the methods and assumptions that we're going to be required to use to calculate that total OPEB liability. And the first step is going to be projecting those benefit payments that are going to be required to be paid out with the OPEB. And then we're going to take that projected benefit payment and we're going to discount that to the actuarial present value. And then finally, we're going to take that projected benefit payment that has been discounted, and then we're going to attribute that to the periods of employee service on a basis that we'll touch on in a little bit.
So, and again, attribution, just a fancy word for allocation and spreading over. So project what you're going to pay, discount it so we get dollars equal to dollars, so there's no apples to oranges comparison, and then spread it over the person's working life. So let's dive into the concept of projection. Now remember, when we're talking OPEB, we can be talking a bunch of different things. We can be talking medical, dental, vision, which is always subject to 74 and 75. But we could also be talking about disability payments, or we could be covering life insurance, and that could either be subject to 67 and 68 if it's run through a pension plan, but if it's not, it's also here in 74 and 75 for those that are not run through a pension plan. So some of this will apply and some of it won't, depending again on what is in your OPEB. So why don't you give us a little understanding of how we do this projection?
Yeah. So first of all, as we all know, we're going to start with that actuarial valuation, and that's going to be used to project those benefit payments. And that valuation is going to be based on certain claim costs or age-adjusted premiums, which approximate the claim costs, and then other benefit terms, legal agreements that existed at the measurement date. And then from that valuation, we're also going to be required to project those benefits incorporating different methods and assumptions, and those can include the projected salary changes and service credits, and that's only if the OPEB formula incorporates future compensation levels and periods of service. We're also going to look to incorporate projected automatic post-employment benefit changes, and that's going to include any of your automatic cost of living adjustments. Also, we're going to look at ad hoc post-employment benefit changes if they're considered to be substantive. And then finally, any other certain taxes or other assessments expected to be imposed on the benefit payments.
So the most important thing here, the actual valuation basically says, okay, from the day that the person retires, and then typically until the day that they die, what is the cost of the medical, of the dental, of the vision that we're going to provide to them when they're retired? Because we don't want to recognize that as an expense when they're retired. We want to recognize the cost of our employees when they're working for us. So we're going to project all of the future payments. So when we look at claims costs or age-adjusted premiums, those are related to your medical, dental, vision. However, if you had disability or you had death benefits, obviously that's more salary driven. So when we're looking at this, you're going to have to ask yourself, what is it that's in my plan that's subject to 74 and 75? And then you're going to make your projection as we go through this. Now, that's one of the big areas that we have to think about is what do we incorporate? And we're going to have to plan. Now, what are the things that we know, no matter what side of the political aisle you sit on, is that health insurance gets more expensive every year. And that's called the healthcare trend rate. And so during this projection, we're not looking at the cost to provide medical, dental, vision today. If you're 25 years old today and you're going to retire at 65, we need to project what the cost of your insurance will be when you're 65 years old until maybe you're going to live to be 95 years old. What is the cost of that medical, dental, and vision? And so the actuary has a very rough job here in making that projection. Now, a question did come in regarding, do you have to have an actual valuation if you have less than 100 employees? We do have a slide coming up on this, and the answer is not necessarily. There is an exemption under GASB for an alternative measurement method, but you do need to check your states because some states are not permitting that or limiting the application of that. So GASB does give you an exception. However, you do want to make sure that it's 100 employees active and inactive, because if you have more than 100 employees when you incorporate your retirees, then you can't use that alternative method. So thank you for asking that question. All right, so once we have done this projection, the next step is to do a present value calculation because we need to do a discount of present value in order to get an apples to apples comparison. And so how do we calculate that discount rate?
Yeah, first we're going to take that projected benefit payment and then we're going to use that actuarial present value using a blended rate, and that's going to be your long-term expected rate of return on OPEB plan investments, and that's if your net position is projected to be sufficient to make those benefit payments. And then we're also going to be looking at a tax-exempt high-quality municipal bond rate, a la the 20-year tax-exempt bond rate.
So basically what you have to do is year by year, calculate what is my plan's fiduciary net position projected to be. And so this might go out 80, 90 years. And then in that column, we're going to list what do we project our fiduciary net position to be. In the second column, you're going to ask yourself, what do we project our benefit payments to be? And in the years where the benefit payments are less than fiduciary net position, meaning you have enough investment set aside, you get to use your long-term rate of return. However, in the years where you don't have enough money set aside in your fiduciary net position to cover that benefit payment, then you need to use that tax-exempt bond. And so thinking about the impact of that, if you think about the average rate on a long-term rate of return, across the country, it's about 7 to 7.5%. But if you were to look at a 20-year tax-exempt bond, it's somewhere between 2 to 3%. The lower the discount rate, the larger you're going to have in terms of your liability. And so when we're thinking about this, we really have to be very careful, because for those entities that have no fiduciary net position, pay as you go, then you're going to be stuck with just that 2.5% 20-year tax-exempt bond. That's going to have a really material effect when you do your OPEB. All right, so once we have our discount rate, when we've done our present value calculation, we now need to spread that over the useful life of the, or I shouldn't say useful life, during the working period of a particular employee. And so what is that methodology called for an actuarial valuation?
Yeah, so the actuarial cost method that we're going to be using is the entry age normal. And that's going to take each individual or participant's service cost as determined as a level percentage of their pay, and then we're going to look to attribute that on an employee by employee basis, and that's going to range from the first period in which the employee provides service under the benefit terms, and it's going to stretch all the way through their exiting active service. So that's how we're going to attribute that to the employee's service life.
Now, it's very important to note that under the actuarial sciences, we call this the Actuarial Standards of Practice, or the ASOPs, there are 6 permitted attribution methods. However, GASB only picked one of them. Very similar to depreciation, we don't want to have different methods of spreading. So if you think about it, depreciation, at the end of the day, whether you use double declining balance, units of production, straight line method, at the end of the useful life of the asset, the amount of depreciation recognized is exactly the same. We want that same concept to be applied here. If we use one of the 6 methods, they all spread the same number. However, in order to get an apples to apples comparison, some of them, when we look at the methodologies, are very front-loaded versus others that are very back-loaded and some that more spread equally. And what GASB said is, in order to be able to compare governments, you had to pick one methodology. And so today you might be using something like projected unit credit. That will no longer be permitted under 75. All entities will be required to use the entry age normal. And that's really very important, because when we look at our actuarial valuation, we need to make sure that the actuary used the proper method, because technically, as an actuary, they can look out and see the 6 options. But GASB only permits one of the 6. So the first thing you should do when you look at your actuarial valuation is ensure it says entry age normal. All right, so when we do this, it can be a little bit confusing for people because there's so many different dates that we need to think about. So can you tell us the difference between the fiscal year end, the measurement date, and the valuation date?
Yeah, absolutely. So I think the easy one for everyone to kind of grasp is that fiscal year end. That's going to be the employer's year end date. And then from there, we're going to try to determine or reach the measurement and valuation dates. Now, the net OPEB liability is going to be required to be measured at a date no earlier than the end of the employer's prior fiscal year and no later than the end of the current fiscal year. And so that's going to be your measurement date in between there. You're going to select that, and that's going to need to be consistently applied year after year, period after period. So that's going to be your measurement date. You're going to set it and move forward with that date in mind for future periods. And then the valuation date is a little bit different in that that's the date at which the actuarial valuation is performed. Now that actuarial valuation date is not, if it's not performed on the measurement date, there are going to be required roll forward procedures to meet up with that measurement date, so we have a consistency there.
All right, excellent. So when we think about this, as an entity, if you're a single employer, you get to pick your measurement date, right? Your fiscal year end is your fiscal year end, but you get to pick your measurement date. Now, a big important factor here is your measurement date has to align with your plan. So if your plan and your employer have the same fiscal year end, then you have a choice of your current fiscal or your prior fiscal. However, if you do not have the same measurement date or same fiscal year end as your plan, then you have to use the plan's year end. So for example, if you have a 6/30 year end, but the plan has a 12/31 year end, then for 6/30/18, you'd be required to use the 12/31/17 date as your measurement date. Because the valuation can be done every 2 years, that allows you that 30 months in one day. It's the 2 years, 24 months, plus the 6-month differential in your measurement date that gets that 30 months in one day. So when you're doing this, because you're allowed to use a valuation that's a little bit older, you can have up to 3 dates that you have to be tracking as you're going through this process. So when we are doing this, and we said at the end of the day, our goal is really to put this liability on our books, what is the difference for a single and agent plan versus a cost-sharing plan?
Yeah, so I think this is one of the bigger differences we've seen between GASB 68 and 75 is that a lot of those pensions were coming on with state pension plans, and we were familiar with those cost-sharing plans. We were going to be using a proportionate share of the collective net OPEB liability, applying that on a entity-by-entity basis. However, with 75, we're seeing a lot of single and agent plans where we're just calculating it for the one plan, and that's going to be our net OPEB liability. So the difference there is just the additional step of calculating in the cost-sharing plan that proportionate share versus just reaching that net OPEB liability, and that's your final amount that you're going to record.
And very important to think about here is that your experience with OPEB, if you were in a state-run OPEB plan and now you're in if you were in a state-run pension plan and now you're in a state-run OPEB plan, everything that we have done under pensions will be exactly the same. But if you were in a state-run pension plan and now you are in a single employer plan, everything that the state did for you, you're going to have to do on your own this year. And so this is a really important concept that when you're doing this, a lot of the work will be put onto the local employers if they're moving from a state-run pension to a single employer local plan. And when we look around our footprint, that is a vast majority of entities, although we do see some agent plans. So when we calculate our liability the first time, it would be nice if it just stayed that liability forever, but that's just not the case. So the liability is going to have changes happen to it. So what are some of the changes and how do we recognize that in the income statement?
Yeah. So a good majority of the changes we're going to run through expense immediately, and those are going to include your current period service costs, interest on your total OPEB liability, as well as any changes in benefit terms, and then also any projected earnings on OPEB plan investments that are required to be included in the determination of expense. But then we're also going to look at 2 other instances of changes, and they're going to be handled a little bit differently, that we're going to have those deferred and recognized over the average remaining service life, and that's going to be for any changes in economic or demographic assumptions and the difference between the estimated and actual period. And that estimated or that average remaining service life is going to be a systematic and rational manner, and it's going to be a closed period equal to the average of the expected remaining service lives of all employees, and that's both inactive and active employees. And then the final piece is any differences between projected earnings on the OPEB plan investments and actual experience. And those we are going to defer and recognize over a 5-year period rather than that average remaining service life.
So when we think about this, every year that someone works for you, they earn another year of liability, right? So every year that they go to work, we need to expense another year and put money in the bucket so that when they retire, we have a bucket big enough to cover all of their costs. Because we have a liability, we need to recognize interest on that liability. But one of the biggest differences under 74 and 75 is that change in benefits. In the past, we actually were allowed to defer it, but if you make a change to your benefit plan, then you're going to actually run that directly through the expense, no deferral. Now, when you're asking what is the average remaining service life, well, it's really easy. You take an individual person, and so say we have Joe firefighter, and he's 25 years old. And because he's a firefighter, we're going to say that he's going to retire when he's 55. That means that Joe has 30 years left. Mary Sue, who is an executive assistant, has already done 30 years of service, and she's going to retire after 40 years of service. So Mary Sue has 10 years left. And then we have our individual who is already retired, living on the beach in Florida, having martinis for breakfast, and their remaining service life is 0. And literally what you do is employee by employee, you calculate what is their remaining service life, and then you average it. Across the country, the average remaining service life is just over 5 years. So that tells us that we have a significant number of retirees in the system, and that we also have a more experienced staff typically at our governmental units. So a kind of an interesting perspective as we go through this. Now, your average remaining service life can change, and so that's recalculated every year, and that will have an impact on your deferreds. So let's talk a little bit about cost sharing, because they have 2 other reasons why we're not going to take an expense immediately. They're instead going to be deferred and then recognized over that average remaining service life. And what are those 2 changes?
Yeah, the changes include the any changes in the employer's proportionate share. So how we talked that proportionate share is going to be calculated every year. Any changes related to that are going to be deferred and recognized over that average remaining service life, as well as any differences between employers' contributions and the proportionate share. So those 2 pieces are the different aspects of cost-sharing plans that we don't see in single and agent plans that are going to need to be considered.
And when we talk about change in proportionate share, remember every year we're going to calculate our percentage based on our long-term contribution rate. So if you're 3% one year and 3.5% next year, and say the OPEB liability is $1 billion, you don't want to take a 0.5% hit in 1 year. So this is what's allowing us to defer that through our deferred inflows and outflows of resources, and then recognize it into expense over the average remaining service life. All right, so sorry, a little heavy on my hands here. So for a lot of entities, they are actually not going to be in a trust fund. The vast majority of our clients, based on our understanding, are not using a trust. So what would this impact be in terms of or if they're not in a trust, and if they are insured versus they are not insured?
Yeah, so if we take a look at first the use of insured benefits, that's going to be our employers that provide insured benefits where they have an arrangement with an insurance company. They're going to pay those premiums, and those are going to be expensed, and that insurance company is going to undertake the obligation to pay the OPEB for all the active employees. So like I mentioned, we're going to expense those premiums in accordance with the agreements with the insurance companies, and then a brief description of the benefits and other information is going to need to be disclosed in the financial statements related to the arrangement. And then if we look at anything that's not insured, and those are going to be for plans that are not in a trust and not providing insured benefits, a similar methodology and approach for the measurement of OPEB liabilities, expenses, and then our deferred inflows and outflows are going to be used. And then we're also going to need to incorporate any modifications to reflect the absence of OPEB plan assets. And we're going to be looking at the total OPEB liability rather than the net OPEB liability, since that plan asset is 0 to subtract from that. And then also that discount rate, more than likely we're going to be looking at that municipal bond index, since there's no plan investments.
So when you have a plan that's not insured, you still have to project, you still have to discount, you still have to attribute, right? The methodology is exactly the same. The only difference is some of those inputs. And so that's definitely something that we want to make sure that people understand, is that their process is the same whether you have a trust fund or you do not have a trust fund. All right, so that brings us to our second polling question of the day. And so again, we're just trying to think about where you are in the process. And so this is a pretty easy one. Have you actually received your report from your actuary yet? So if you're a governmental entity that has OPEB, the choice is going to be yes, no, or I'm not sure. If you're a governmental entity that does not have OPEB, or you're not from a governmental entity, NA is probably your best option. So again, we just want to make sure that you select one of those radio dials next to either yes, no, I'm not sure, or not applicable. So have you received your report from your actuary at this point in time? Many of you having those 6:30 year ends. We do have quite a few of you from the Florida world that will have a little bit later, those 9:30s coming in. But in the North Carolina, Virginia, South Carolina area, we have a lot of those 6:30s that are on the line. So just trying to get a feel from you guys in terms of, have you actually looked at your, so we see some people have drafts. That's fantastic. All right, so I'm going to give you another 2 seconds to answer that poll. All right, let's close that one down and broadcast the results. Oh, this is an interesting one. So only 22% of you have your plan actuary report in place. So let's get started on those, because for 6:30, that's going to be really important for those of you who are not sure, something you definitely want to check in on. And for those of you who definitely don't have it, I would start looking for that pretty soon, because one of the reasons why we use an earlier measurement date is to give us more time in order to be able to put this together. And so we're starting to eat into that more time concept right now. All right, thank you guys so much for participating in our polls. Let's head back to those slides. And let's take a look at another standard. Now, this standard has some pretty interesting usage as we go through it. So when we look at these types of agreements, what we're finding is that they're not like people are saying, gee, I feel like I didn't pay enough taxes, so I want to put a bunch of money aside for my county or town. But we are seeing a lot of people who are saying, you know, I'd love to give money to my library, my public library, or to my local elementary school, or my public university that I attended as an alumni, right? So when we see this, we do see it in limited usage, but in the past we had no guidance. We would have to use FASB guidance. And so because of that, this is an opportunity for us to have guidance that makes sense for governmental entities, because nonprofits have been doing this for a very long time. But now we're looking at actually governments having to deal with these split interest agreements as well. So give us a little background here on how we go through GASB 81 in terms of the background.
Yeah. Like you said, FASB's had it for a long time, and it's good to see it implemented for GASB to clarify that guidance on our financial statements. This one was issued in March 2016, and it's going to be effective for periods beginning after December 15th, 2016. And the statement goes through and standardizes the recognition and measurement for various split interest agreements, and they're specific to when a government is the beneficiary in an agreement.
All right, excellent. So what is a split interest agreement? How does it work?
Yeah, so GASB defines the split interest agreement as a specific type of giving arrangement used by donors to provide resources to two or more beneficiaries, including governments. And these agreements can be created through trusts or any other legally enforceable agreements with characteristics equivalent to split interest agreements. And it's when the donor transfers the resources to an intermediary to hold and administer for the benefit of a government or other beneficiaries. And common types of those that we see are the charitable lead trusts, charitable remainder trusts, and any sort of lead interest in real estate. Those are common ones that we see.
So basically what happens in a split interest agreement is that there are two beneficiaries. There can be more, but today we're going to do the most basic version of this. And so a donor says, I want to have money go to two different entities. And so we're going to have a lead interest and a remainder interest. And in a lead interest, the person is going to receive some type of an annuity. And it's either going to be for a period of time or until a life event like death. And then at that time, whatever's left over in that trust is going to then be given to the remainder interest. Now, under this standard, the government can either have the lead or the remainder, and that will have an impact on the accounting. In addition, they could either be the intermediary or not be the intermediary, meaning because the donor can't control the trust fund, someone has to control the trust fund. And so when we have that, it can go to the government to be the one who disperses it, or it could go to a third party. And so what we're going to do today is walk through some of the more basic versions of this where you just have two beneficiaries and what the accounting would be. So in our first scenario here, the government is the intermediary, meaning that the donor has given the trust fund to be handled by the government, and the government has a remainder interest, meaning that we're going to just use the life event because that's the easier version, that the person's going to have an annuity being paid, and I'm just going to say to not-for-profit entity A, for a period of time until they die. Then whatever's left over, the government is going to get to keep. So in that scenario, what would be the proper accounting?
So in the first aspect of this is we're going to record the asset for any resources received or receivable, and that's going to be just in accordance with our existing standards. But then we're also going to look at a liability for the lead interest that is assigned to that other beneficiary. So whoever is that lead interest, we're going to have a liability associated with that. And that amount's going to be measured based on the settlement amount or streams of payments that are expected to be provided to that other beneficiary. And then any other disbursements will in turn decrease that liability. And then on the flip side, we're also going to have the deferred inflow of resources for that government's unconditional remainder interest. And so at the termination of the agreement, that deferred inflow, once we receive it from that lead interest, is going to be recognized into revenue, and in turn, any remaining liability is going to be washed away and recognized as a gain if it's still outstanding there.
Okay, so in this scenario, we're receiving the trust fund, so we need to debit the assets. But then we owe the lead interest all of their payments. And so if it's going to be an annuity, we're going to do a present value of our expected payments. And then based on that, that is going to give us our debits equal our credits, right? So if we debit these assets and we credit the liability for the calculation of that present value, whatever's left over is therefore a credit to a deferred inflow. And that's our amount that's going to be left in the trust fund after we make payments to the lead interest. Now, in this scenario, we always want to remember that it doesn't matter if we're the remainder or if we're the lead. We always give the liability to whoever the other party is. So in this scenario, if we're the remainder, the liability goes to the lead interest. If we're going to be on the other hand, let's switch it, and now we're the lead, well, then the liability is going to be to the remainder, right? So it's very, very easy. In both scenarios, if we're the intermediary, we're going to get the assets, and the credits have to equal the total of that asset. So the deferred is always going to be our portion, and the liability is always going to be to the other person. But what if we're not the intermediary? And so in that scenario, Brian, how would that impact us?
Yeah, so when we're not the intermediary, we're once again going to recognize the asset, but then we're also going to have the deferred inflow of resources for when the government becomes aware of the agreement and they have sufficient information to measure the benefit information. And we're only going to do that provided that the government is specified by name as a beneficiary in the legal document. We're also going to make sure that the donation agreement is irrevocable. The donor did not grant any variance power, or the donor does not control the intermediary. and the agreement establishes a legally enforceable right for the government's benefit. So once we have those in line, then we're going to record that asset and deferred inflow, and we're not going to have that liability that we had in the other instances because there's not the other lead or remainder that we have to recognize.
In this scenario, because we're not the intermediary, we're not receiving the assets. And so because we're not getting the assets, we're actually just going to recognize it's like a receivable. It's called a beneficial interest. So we are entitled to it. So it's sort of like a receivable where we recognize an asset, and then we're going to recognize our portion of that based on whether we are the lead or the remainder. So it's still going to have two. We're still going to have a lead. We're still going to have a remainder, except because we're not the intermediary and we don't have all the assets, we just book our side of the equation, and the other person will book their side of the equation, and we don't owe anyone anything because we are not the intermediary. We're not holding this. And so I think that is one of the big nice aspects of this. And so if you have these, it's definitely something you would want to make sure that you're comfortable with. All right, let's move on now. We're coming a little short on time, so I'm going to pick things up a bit and cover a couple of things a little bit more quickly. So let's talk briefly about GASB 83. I'll take this one for the group. And in 83, we have what we call an asset retirement obligation. And when we have asset retirement obligations, this is now going to be effective for those fiscal years that are about to start, so beginning after June 15 of 18. And for this, we're going to have to recognize a liability if we have an ARO other than a landfill. Now, the important thing here is that we have to remember what is an ARO. And it is a legally enforceable liability, meaning we are going to have to pay money in order to retire a tangible capital asset. So I'm going to use the example of a hospital. If you have MRI machines or you have machines that deal with a lot of nuclear activity or radioactivity, you just don't get to throw them away. You have to properly retire them. Or if you have a gas station and you have all of your stuff underneath, you just can't walk away from it. You have to pay a lot of money to retire that asset. And we don't want to recognize the cost of retiring that asset at the time of retirement. We want to recognize the cost over the useful life of the asset. And so in that scenario, we're going to recognize a liability at the time that we have this requirement. And so the standard says that you should recognize it when it is incurred and reasonably estimable. Incurred meaning that you have a legal requirement, and reasonably estimable meaning that you have an estimate. And we're going to use a best estimate basically based on today's current outflow. So how much would it cost today in order to actually do that? And then what we're going to do is we're going to estimate that. Basically a probability weighted average. However, if that's way too expensive, we're going to just use our best estimate. Now, when we have an ARO, we are going to we're going to credit a liability, and we need a corresponding debit. So we're going to recognize a deferred outflow of resources. And so that deferred outflow of resources is just going to be the equal of whatever the liability is. And what we're going to do is we're just going to amortize that out. We're going to expense it over the useful life of the asset so that when we get to the end of the useful life, there is no deferred outflow left, but there is a liability on our books ready for whatever costs come in hand. And that liability is going to be adjusted for inflation every year. And so as we go through this, so here's that definition of incurred. And so as we go through this, one of the things that we need to think about is when we're looking at it, we really want to make sure that we are adjusting it for inflation as we're looking at it. So because we're putting it on at our current cost, we want to make sure that we're able to actually retire it at the proper cost. So we're going to adjust it for inflation or deflation, the liability, and the assets or the deferred outflow is going to be amortized over the useful life of the asset so that when we get to the end, we don't have any issues and we would just have the liability at the current cost in the future, right? Adjusted for inflation. So based on that question, we have a poll for you. Do you believe your entity will need to recognize an ARO? And so these are going to be hospitals. They're going to be entities that may have tangible capital assets that simply cannot be thrown away, that you're going to incur a cost in order to retire them. And so we do expect that various entities, depending on the type of entity, will incur these. And so your choices are yes, no, I'm not sure, and not applicable. All right, so one of those four choices, please make sure that you do hit that button there right next to the words. I'll give you 2 more seconds. All right, let's close that poll and broadcast the results. Wow, so a lot of you aren't sure, and 20% of you are positive that you do. 11% of you say, I don't have to follow GASB, so I'm good to go. And about 40% of you say, we don't have any of these tangible capital assets that have a cost to retire. All right, excellent. Let's head back to those PowerPoints now. All right. So another standard that we need to be paying attention to here is related to fiduciary activities. And I do want to let you know that we have a full 1-hour webinar coming up on fiduciary activities. Later in 2018, we have an awesome speaker coming to talk to you guys about this because this is a huge standard. It will have a fundamental change on our fiduciary activities. So we didn't want to do too much today. We're just going to give you a little bit of a tease. And so this was issued back in January of 17. It is effective for 19 calendar, 20 fiscals, and it is going to change how we do our fiduciary activities. Now, one of the things you'll notice is that we change our fund types. Today we have 4 fund types, but the last one is custodial under the new standard. Prior to that, it was an agency fund. And so one of the things that will have a big difference is obviously looking at the definition of our funds and whether we qualify under these new standards. All right. One of the things that we have to look at here is how do we know if we are a fiduciary activity? And there's 4 different things that could happen. You could be a pension or OPEB plan, and you would be a component unit. And in that scenario, you would follow 73, 74, et cetera. On the other hand, if you are not a pension or OPEB, but you're a component unit, there is a set of rules regarding whether you have a trust fund or whether you are looking at the benefit of who it is and whether the government has what we call administrative involvement or direct financial involvement. Or, again, when we're looking at who the beneficiaries are in terms of an organization. In addition, there's also the concept for when you're not a component unit, you're not a fiduciary activity, what would be the requirement here? And so in that scenario, we would have to look at the concept of control and who is deriving them. So as I said, we can't go into a ton of detail today. We did want to introduce this topic for you, but we will have a more detailed 1-hour webinar in the future. Let's now talk quickly about the Omnibus. Can you tell us, Brian, a little bit about the background here?
Yeah, so Omnibus, like I mentioned earlier, is kind of just a hodgepodge of several accounting and financial reporting issues that they wanted a little bit more clarification on. It was issued in March 2017, and it's effective for periods beginning after June 15, 2017. And it's going to cover topics like component unit presentation, goodwill, and negative goodwill, as well as fair value measurements and a lot of other clarification on OPEB and post-employment benefits.
All right, excellent. So as you can see here, there's quite a bit of items. Why don't you pick some of the big ones that we would want to think about?
Yeah, so I mean, the first one, we're going to have some clarification related to blending a component unit, and that's when a primary government is a business type activity and they're presenting in a single column financial statement. So there's going to be guidance there clarifying how that blended component unit is going to be presented. There's also related to money market investments. Those are now going to be categorized at amortized costs, and that's also going to be including any participating interest earning investment contracts. And then, like I mentioned, there's a large majority of this relates to OPEB, including on behalf payments, that RSI related to payroll, a little bit of clarification there, and then finally other accounting and financial reporting related to any certain multiple employer benefit plans.
All right. The big thing here, remember, is the goodwill portion of it, and that really has to do with the fact that GASB 69 was prospective, and then a lot of these were what we already did for pension, except being applied for OPEB. So just clarifying what we would already have expected for a lot of this. All right, let's keep moving here. Another one that is not going to have too much of an impact because I just don't envision so many governments having a ton of money lying around. But when we look at debt extinguishment, what is the purpose of this standard?
Yeah, so we were seeing, or GASB was seeing, many governments were currently accounting for certain debt extinguishments differently based on the funding source used to defease it. And they would be reporting it differently if they were using bond refundings or other sources that they had internally. So the purpose of this update or this standard was to improve that consistency, make it that you were reporting it consistently, whether you were using internal resources, a la cash or other monetary assets, versus if you were using other debt to extinguish the debt that you had outstanding. And this one was going to be
All right.
Effective for periods after June 15th, 2017, so this upcoming year.
All right, excellent. So basically all this does is standardize. It basically says that if you have an advanced refunding where you're borrowing money to defease the debt, you should treat it the same way as if you just randomly have all this money lying around and you want to just put that in a trust fund to defease the debt without having to borrow any more funds. All right. Now, a biggie is GASB 87, and of course, we're not going to go into great detail on it today, but I am pleased to report that we have a full-length 1-hour webinar just on GASB 87 also planned for you this year. And this one is going to have a huge impact on our governments because there's no such thing as an operating lease anymore. Now, we do have a little bit of time. It's not effective until calendar 20, which would be fiscal 2021. But it's something that's going to require a little bit of consideration. And the biggest reason why is that they've changed the definition of a lease. So there are things today that are not treated under lease standards that would qualify to be a lease. And there's also those things that are leases today that will not qualify under the new definition. In addition, the lease term is now judgmental. We no longer use minimum payments. We want to look at the expected cost. And so when we look at that, that includes option periods. So if you have a 5-year lease and you have the option to extend an additional 3 years, if you are reasonably certain to exercise that option, we're going to say that the lease term is actually 8 years. So no longer will it be just the non-cancelable portion. It will also include the consideration of options to terminate, options to extend, and those that are at the lessee's choice or the lessor's choice. Now, there is a short-term exception, but that short-term exception only applies if you have a maximum possible term of 12 months or less, including option periods. So if you have a 1-year lease and the option to extend it another year, you no longer qualify for that short-term exception. So the vast majority of all of our leases that are operating today will now be on the balance sheet like our capital leases. Unlike FASB, which went with a dual model approach, GASB was more similar to the IASB and went with a single model approach. And therefore, all of them will be treated the same way. There will be no operating and capital. There'll just be one type of lease where basically we recognize the lease liability and what we call a right of use asset, which is an intangible asset that's going to be amortized. It is not going to be depreciated because we're not recognizing the asset itself. We're recognizing our right to use someone else's asset. And so this can have a pretty big impact on our entities. So as we look going forward, we were going to, when we look at our lease liability, not just look at our minimum lease payments, but look at all the payments that we expect to make, whether they're based on an index or a rate, if they are a residual value guarantee, if there are penalties, all of those now need to be incorporated into the lease liability. In terms of the discount rate, we want to use a rate that is implicit in the lease or stated by the lessor. But if we don't know what that is, we are then going to use our incremental borrowing rate. which is the rate if we were to go to the market to borrow money on a collateralized basis for the same period of time, for the same amount, what would a bank charge us? So a little bit different in terms of our calculation. In terms of our asset, it is going to be the initial lease liability, and it's going to be adjusted for our initial direct costs plus or minus any lease incentives or upfront payments. So your debits always equal your credit, but your asset will not necessarily equal your liability. Your asset could be more or less than your liability based on the calculation here. So one of the big differences is that when we do our tables, they might be a little bit different. As I said, we're going to amortize this on a typically straight line basis over the life of the lease. Now, if it is we look at the shorter of either the lease term or the useful life of the asset. So if it's a 7-year lease and it's a 10-year life, we would do it over 7 years. Unless there's an option to purchase and it's reasonably certain we're going to exercise that, then we would do it over the useful life of the asset. So that's it on the lessee side. When we come back, we will actually do lessee and lessor accounting on GASB 87, as I said, in a full-length 1-hour webinar just on that standard. So we are excited to be able to offer that to you. And so let's look here at our final polling question, which is, what impact will the lease standard have on your entity? And your choices are little or significant, moderate, little, none or not applicable, or I'm not sure. So it might not have any impact, or it might not be applicable to you at all. It might have a significant, moderate, or little, or you're just not sure because we haven't given you the full run of how we're going to do leases under the new standard. All right, I'm just going to give you a couple more seconds to answer. All right, let's close that poll up and let's broadcast those results. All right, so a little bit of everything here. So 34% saying moderate and 21% saying significant. So over half of you are going to have a pretty big impact here. And there's a good portion of you that this doesn't apply to or you don't know. So it could be even greater in terms of the impact. So definitely something you want to be looking out for, and we hope to see you on that future webinar. The most recent one that has come out is related to, let's go back to our slides, please. Thank you. Our most recent GASB to come out actually came out last month, which is GASB 88. Can you tell us a little bit about the background here?
Yeah, so this standard was, like you said, just a month ago, just recently, and it's going to be effective for June 15, 2018, those reporting periods beginning after that. And the purpose of this statement was to improve the information that's disclosed in the notes related to debt. And then it also clarifies which liabilities should be included when disclosing information related to debt. And then finally, it included the segregation of direct borrowings and direct placements as separate disclosures in the financial statements.
Right, so a presentation aspect. But people were literally saying, we don't know what qualifies as debt when we make a disclosure. And users were saying, we don't give you enough information in order to understand the true risk to the government. And so basically, they defined for disclosure purposes only debt as a liability that arises from a contractual obligation to pay cash or other assets that may be used in lieu of cash in one or more payments to settle an amount that is fixed at the date the contractual obligation is established. So once again, looking at that fixed. They did, however, state that there were some exceptions to that. So specifically, AP and leases were scoped out of that standard. In terms of disclosures, they did add quite a few new disclosures here. The amount of unused lines of credit, looking at if you have any terms that would trigger perhaps some type of finance-related consequence, whether it's related to termination, subjective acceleration clauses, or requirements related to default. In addition, as Brian stated, there is a new presentation separating those debt disclosures for direct borrowings and direct placements, where the government is getting the debt directly from an individual, right, from an investor or from a lender, separately from those where they are not directly working with the other side. So again, that just came out, and we have a little bit of time. To close up, we wanted to talk briefly about some of the things that GASB is working on. As you can see here, accounting for interest costs during the period of construction, they proposed that we would not have to recognize that under the new standard. Big difference between FASB and GASB. The implementation guide actually came out yesterday. 2018-01 was issued, so it's actually no longer an exposure draft. It issued yesterday, but we did not have time to update our slides since the issuance of that. And then looking at majority equity interest, also one that we expect to come out later this year. In terms of really long-term projects, we have the financial reporting model. We did a 1-hour presentation for you guys on the changes to the governmental funds. They also have revenue and expense recognition, a holistic review of the changes that they are proposing there. And they're also looking at conduit debt. So quite a bit that they have on their plates, and some of these are looking to be issued in 2022 to 2025. So a lot of these are very, very long-term projects that the GASB is looking to address in large models. So I know that was a ton of information. I want to thank Brian for taking time out of his schedule to talk with us today, and to all of you for joining us, and to Morgan and all of the people on the learning team for helping us make this a successful webinar. We want to thank you guys so much. We've answered all the questions that have come in so far, and so I think we've got that all set. So hopefully this was useful, but Brian would be happy to answer any questions that you have. His email is listed here on the screen if you didn't get a chance to enter that into the question pod. With that, thank you guys so much for joining us, and we hope to see you on a future webinar. Have a great day, guys. Bye-bye.